Right now, something is happening in the markets that almost no one is talking about, but everyone will feel. The rally has been extraordinary, record-breaking, almost unstoppable. Headlines scream new highs, optimism is everywhere, and the crowd is cheering. But underneath that euphoria, a subtle tension is building. The kind you don't see on charts, the kind that whispers, the game is far from over, and we may already be entering the final innings. Every decision you make in the next few minutes could define your success or your regret. The question isn't if the rally will continue. It's how long can it last, and are you prepared when the tide finally shifts? Buckle up, because what I'm about to reveal will change how you see every gain, every risk, and every opportunity in this market right now. The market has shown remarkable resilience over the past several quarters, but resilience is not the same as invincibility. Every advance, no matter how thrilling, carries within it the seeds of its own reckoning. Observing the current rally, I can't help but feel a sense of unease, a subtle tension beneath the surface enthusiasm. There's a common narrative suggesting that innovation, technological breakthroughs, and optimism alone can sustain this ascent indefinitely, but history teaches a different lesson. Momentum can only carry you so far when underlying fundamentals start to strain. Investors are quick to celebrate the highs, the headlines, and the record-breaking gains, yet few pause to ask whether the conditions that enabled these highs are still present or if they are stretching thin. The caution I feel is not rooted in fear, it is rooted in an understanding of cycles. Markets are inherently cyclical, and rallies do not continue in a straight line. Each surge is followed by periods of correction, sometimes minor, sometimes profound. The current environment reflects a stage in the cycle where enthusiasm is high, but the number of participants entering without adequate assessment of risk has also increased. When optimism outweighs reason, the probability of abrupt adjustments grows. This is the subtle but unmistakable signal that I'm attuned to. The market's heartbeat is still strong, but it is increasingly volatile, reacting more sensitively to news, to interest rate signals, and to economic indicators that, in another era, might have barely registered. Technology, particularly in areas perceived as revolutionary, has driven a significant portion of this rally. The allure of transformative sectors has created narratives of limitless potential, encouraging investors to chase returns without fully accounting for underlying valuations. This dynamic, while thrilling in the short term, can be dangerous if not grounded in discipline. I observe the data, the flows of capital, and the behavioral patterns of market participants, and I see a divergence between price and sustainable value. The temptation to ride the wave is powerful, but those who succeed over decades understand that timing, prudence, and awareness of risk are more important than the euphoria of a market peak. To navigate this environment effectively requires acknowledgement of uncertainty, rigorous assessment of risk, and a willingness to act decisively when conditions change. Complacency is the silent threat in any rally. It makes caution seem unnecessary until it is too late. While others may be distracted by near-term gains, the responsibility lies in preparing for the eventual moderation of this trend. Recognizing where we are in the broader market cycle does not imply panic. It implies vigilance. It is the understanding that even in periods of extraordinary growth, a disciplined approach to risk management, a careful calibration of exposure, and constant attention to macroeconomic and monetary forces can distinguish those who protect wealth from those who are swept aside by volatility. In short, this rally is impressive, but it demands respect. Its strength is real, but so are its limits. The responsibility of investing wisely is to recognize both, to enjoy the gains but never lose sight of the cautionary signals that history, data, and market behavior continually provide. The driving force behind the recent rally has been the extraordinary optimism surrounding technological advancement and innovation. Sectors that were once viewed as speculative have now become the engines of market growth, attracting capital at a pace that feels almost relentless. Investors are captivated by the promise of transformative breakthroughs, artificial intelligence, cutting-edge computing, and new-age platforms that purport to redefine entire industries. This enthusiasm is understandable. Progress on these fronts is tangible, compelling, and widely publicized. Yet, the very intensity of this optimism introduces a subtle but critical risk, the tendency to value narrative over fundamentals. When capital flows disproportionately toward a select group of assets or themes simply because they are the future, it creates a feedback loop. Prices rise, more attention follows, and then more capital floods in, amplifying valuations far beyond the underlying economic reality. Markets, at their core, are mechanisms for allocating resources efficiently. When allocation becomes driven primarily by excitement rather than sustainable earnings or measured potential, efficiency erodes and vulnerability grows. What we are witnessing is not just a rally, it is a confluence of high expectations and high conviction that may, in the absence of disciplined analysis, accelerate corrections when the inevitable stressors appear. The allure of sectors seen as revolutionary is powerful precisely because they promise outsized returns in compressed timeframes. This draws in participants who may lack the depth of experience to assess risk fully, yet feel compelled to act because they fear missing out. History is replete with examples where speculative surges, fueled by optimism, peaked long before fundamentals caught up. The danger is subtle at first, volatility remains low, sentiment is euphoric, and early gains mask structural fragility. Only when economic shocks or policy shifts occur do the cracks become visible, often catching the unprepared off guard. Discerning investors must recognize the duality at play. On one hand, innovation is real and meaningful. These sectors genuinely contribute to productivity, efficiency, and growth. On the other hand, the speed at which capital moves and valuations rise can create distortions that increase systemic risk. Understanding his duality requires constant vigilance, monitoring earnings quality, evaluating balance sheets, assessing cash flows, and, critically, anticipating how changes in macroeconomic policy or market sentiment might intersect with these elevated expectations. Those who succeed over the long term are rarely the ones swept up in short-term excitement. They are the ones who navigate the intersection of innovation and discipline, who embrace growth without abandoning prudence, who balance opportunity with awareness of fragility. Ultimately, the current rally is a study in human behavior as much as in financial mechanics. Optimism drives markets forward, but unchecked optimism carries consequences. Recognizing the difference between genuine opportunity and inflated expectations is essential. Markets will reward foresight and caution over blind exuberance. Those who respect both the potential and the limitations of this environment position themselves to benefit not only from the rally itself, but also from the resilience needed to endure when cycles inevitably shift. Markets, much like the game of baseball, unfold in stages. Each rally, each advance, has its rhythm, its momentum, and its limits. When I describe the current market as being in the 7th or 8th inning, it is not a casual observation. It is a careful assessment of where we are in the broader cycle. The early innings are defined by discovery, optimism, and the gradual accumulation of confidence. The middle innings see momentum build, strategies take shape, and the narrative becomes widely accepted. By the 7th or 8th inning, what was once opportunity has matured into heightened expectation, and the room for error narrows considerably. This stage is critical because the dynamics of risk and reward begin to shift. In the early innings, growth can feel limitless because the field is wide open and the forces of innovation are unfolding in real time. By the later innings, however, gains are harder to achieve. Every new advance is scrutinized more intensely and valuations are less forgiving. Investors must be increasingly disciplined, balancing the desire to participate in upside with the necessity of protecting against downside. This is where prudence becomes not just advisable, but essential. The market is no longer a forgiving environment. The margin for miscalculation diminishes as the innings progress. The metaphor also highlights the subtle psychological shift that accompanies this stage. Participants who thrived in the early innings, buoyed by optimism and momentum, may start to overestimate their control over outcomes. They may assume that prior success guarantees future performance, overlooking the mounting structural pressures beneath the surface. This is when volatility can spike unexpectedly, and when the market's response to news, positive or negative, becomes less predictable. Just as in baseball, the later innings demand a heightened sense of awareness, the ability to anticipate the actions of others, and the discipline to act decisively when circumstances change. Understanding where we are in the cycle is not about predicting catastrophe. It is about positioning wisely. The seventh and eighth innings are where preparation meets opportunity. It is where those who have been vigilant can capitalize on strength while simultaneously protecting against risk. Ignoring the metaphorical innings is dangerous because it fosters overconfidence, encouraging investors to treat every advance as permanent. History is clear, even the most impressive rallies eventually face correction. Recognizing the stage of the cycle allows for a more informed approach, blending measured participation with active risk management. Finally, the seventh and eighth innings teach humility. They remind us that markets are larger than any individual, that momentum is not infinite, and that success over the long term depends on a careful balance of ambition and caution. By acknowledging that we are in the later stages of this rally, we do not diminish our ability to benefit, we enhance it. We act with foresight, not recklessness. We value discipline as much as opportunity, and we understand that the final innings will reward those who respect both the game and the forces that drive it, rather than those who assume the outcome is predetermined. Interest rates are one of the most powerful, yet often underappreciated forces in financial markets. Their influence is slow, pervasive, and sometimes almost invisible until it manifests in ways that are sudden and dramatic. The recent period of tightening has created conditions that will unfold over months, even years, rather than instantaneously. This delayed effect is what makes the current environment both compelling and concerning. Markets may appear strong today, supported by optimism and liquidity, but beneath the surface, the cumulative impact of higher borrowing costs, constrained capital flows, and tighter financial conditions is beginning to assert itself in subtle ways. The challenge for investors is that the effects of rate increases are rarely linear. Corporate earnings, consumer behavior, and credit availability respond gradually and often asymmetrically. Companies that have relied on cheap financing to fuel growth may find themselves constrained, while consumers adjusting to higher rates may reduce discretionary spending. The full impact on valuations, particularly in sectors that have been priced for perfection, is only starting to emerge. Observing market indices alone can be misleading because headline gains may mask pockets of stress that are quietly building beneath the surface. It is critical to recognize that these changes do not manifest evenly across the market. Some sectors, particularly those sensitive to leverage or long-duration growth projections, experience pressure more quickly. Others, insulated by strong cash flows or structural advantages, may appear resilient. Understand, the nuances requires disciplined analysis, separating short-term exuberance from long-term risk. This is not speculation. It is careful attention to the mechanics of how capital costs influence corporate behavior, investment decisions, and ultimately, market outcomes. Moreover, the delayed impact of rate increases creates a psychological dynamic that can amplify market volatility. Investors tend to anchor to the present, interpreting strong recent performance as proof of resilience while underestimating the latent effects of monetary tightening. This optimism, if unchecked, can lead to overexposure, magnifying losses when adjustments occur. The prudent approach is to anticipate how the cumulative effects of higher rates will intersect with valuations, earnings expectations, and economic indicators over the next several quarters. Acting proactively rather than reactively differentiates those who endure volatility from those who are swept aside by it. Ultimately, the lesson is clear. Rate increases are not a blunt instrument with immediate visible consequences. They are a slow-moving force shaping the environment in ways that require foresight, discipline, and patience. Markets can feel invincible in the moment, but history demonstrates that the full consequences of monetary policy always surface, often when least expected. Awareness of this delayed effect allows investors to navigate growth with caution, to position intelligently, and to manage exposure before adverse conditions materialize. The strength of today's market is real, but so is the underlying friction building quietly. Recognizing both allows for strategic participation while safeguarding against surprises. Even in the midst of a strong rally, the market never operates in isolation. Beneath the surface gains, Subtle shifts in the economy are taking shape, signaling that conditions are more complex than the headlines suggest. Rising interest rates, changes in consumer behavior, and adjustments in corporate spending are all beginning to leave their imprint. The strength of the market, while impressive, cannot be divorced from the underlying realities of the economy. And it is precisely these emerging headwinds that demand careful attention. Ignoring them would be a mistake that history has shown is costly. One of the most immediate indicators is the behavior of consumers. After years of abundant liquidity and low borrowing costs, spending patterns are starting to adjust. Discretionary spending shows signs of moderation, and the ability of households to absorb higher costs is being tested. These changes do not always manifest in dramatic headlines, but they do influence earnings, revenue growth, and investor sentiment. Companies that depend heavily on consumer activity may find that their growth projections, which seemed certain during the early innings of the rally, now require recalibration. Recognizing these subtle shifts early allows investors to adjust exposure and manage risk before pressures become more pronounced. Similarly, the labor market is beginning to reflect a more cautious stance. While unemployment remains relatively low, the pace of hiring and wage growth is showing early signs of moderation. These trends have ripple effects. Slower wage growth can dampen consumer confidence, impact discretionary spending, and ultimately influence corporate revenue. For investors, understanding these dynamics is crucial. Market rallies often continue long after underlying fundamentals have shifted, but the disconnect between perception and reality can create volatility that is sudden and severe. Awareness and preparedness, rather than reactionary behavior, provide the edge needed to navigate these conditions. Corporate behavior is also adapting to these headwinds. Companies reassessing investment plans, capital expenditures, and growth initiatives in response to higher borrowing costs and more uncertain economic conditions. This cautious approach is rational, yet it can have broader implications for market momentum. The sectors most sensitive to financing costs or global economic pressures may experience disproportionate stress, even as headline indices continue to climb. Understanding which areas are vulnerable and which remain resilient is a key part of disciplined market participation. Finally, it is essential to recognize that economic headwinds are rarely uniform. Some sectors and regions may continue to perform strongly, buoyed by structural advantages, innovation, or international demand. Others will face constraints that slowly erode confidence and valuations. Success in navigating this environment requires the ability to differentiate between temporary setbacks and fundamental shifts, to allocate capital intelligently, and to remain vigilant in monitoring both macroeconomic signals and market behavior. In conclusion, while the rally has been impressive, the emergence of economic headwinds reminds us that no market advance is infinite. Awareness of these forces, slowing consumer demand, moderating labor dynamics, and cautious corporate behavior allows for strategic positioning. The goal is not to predict disaster, but to act with prudence, discipline, and foresight, ensuring that participation in growth is balanced with protection against the inevitable challenges that follow in the later stages of any cycle. So here's the truth you need to hear before you make your next move. The rally isn't just climbing, it's testing the limits, and the innings are late. The momentum that carried us this far is fragile, and the next few plays could change everything. Complacency is the enemy, and hesitation is the costliest mistake you can make. The opportunity is real, the risks are real, and the clock is ticking. Stay disciplined, stay vigilant, and act with foresight, because the winners are never the ones who wait for the last out. They're the ones who prepare, anticipate, and strike at exactly the right moment. The game isn't over, but the final innings have already begun. The question is, will you be ready when everything changes?